to Morning Markets. I'm Amber Kanwar. It is decision day for the Bank of Canada, and never has been an expectation of no change perhaps been more exciting, because it is the first time in 8 consecutive meetings that the Bank of Canada will put its conditional pause into practice. We are expecting the Bank of Canada, when it makes its trend-setting interest rate decision in less than 90 seconds, to keep rates at 4.5%. But of course, there are some fireworks that emanate from that. There's consequences for Canada going its own, being one of the only major central banks to put that pause into practice, and that is a big divergence from what we see in terms of the Federal Reserve. That was underscored yesterday when Jerome Powell signaled that rates not only may need to move higher in terms of the peak rate, but might need to go higher even faster, putting 50 basis points on the table at their March 22nd meeting. This is where some of that key divergence is going to show up in the Canadian dollar. About a year ago, the Canadian dollar was trading close to 80 cents, and now here we are at 72 with some potential further downside. And that's going to have an impact on inflation, folks. When you talk about that weaker Canadian dollar, it could stymie the Bank of Canada's efforts to bring inflation down. Remember that weaker currency here tends to mean countries with weak currencies import inflation. So we'll be watching to see if there's any language added around the Canadian dollar. We are 10 seconds away from that Bank of Canada rate decision. Of course, if you have had a mortgage or thinking about getting a mortgage, this is of keen interest to you. We've already seen that slowdown in the housing market show up in things like sales, deterioration in prices. As expected, the Bank of Canada has held rates at 4.5%. Again, this is the first time after 8 consecutive rate increases that the Bank of Canada has put its conditional pause into practice. As I go through the statement, they say that they have held their rates, continuing its policy of quantitative tightening. They talk about Canada and the economic growth, referencing that at the fourth quarter, growth slowed down. So again, validating the Bank of Canada's decision to pump the brakes on rate increases, noting that economic growth in Canada for that fourth quarter came in lower than the bank projected. The labor market, of course, they reference, just kind of confirming what we see in the data, remains tight. Now, one of the sentences that they added last time was that they were going to assess the economic developments and the impact of past interest rate increases. They have said that they continue to do that they will assess economic developments and the impact of past interest rate increases, and is prepared to increase the policy rate further if needed to get inflation back to the 2% target. And that is exactly what they said in the last statement as well. So kind of apples to comparison. That was the key language shift the last time around. You're seeing a little bit of a reaction in the Canadian dollar here. But again, we're not on an island when it comes to our interest rate decisions. We've got a great panel assembled for you to help go through what this means for you and your money. We've got Francis Donald, who's the global chief economist and strategist at Manulife Investment Management, and Kim Shannon, who's the founder and co-CIO of Sionna Investment Managers. Ladies, thank you so much for being with me. I'll send it off to you first, Francis, to kick things off. We were expecting this. But just because we're expecting it doesn't mean there's not any nuance around it. What's your initial take?
And certainly just because the Bank of Canada looks like it does nothing does not mean the Bank of Canada is not very busy right now, probably in overdrive, trying to assess just how much impact these prior hikes are going to have on the economy. And this is really the game for the next several months, is how quickly is this economy going to slow down? Is the labor market going to follow it? And of course, is inflation going to follow suit and really see that slowdown in momentum moving forward? Now, you do have this issue that's occurring at the same time, which is a Federal Reserve that's still hiking. I don't think we should make too much of a big deal about this. We have two very separate economies. Yes, the Canadian dollar is in part driven by yields, but not solely driven by yields. In fact, what drives the Canadian dollar fluctuates over time. This is a Bank of Canada that knows 25 basis point hike in Canada can be more powerful and bring growth down more in Canada than the equivalent in the United States. So this is caution we're hearing from them.
It sounds like you agree that there shouldn't be too much made of a diverging path between the Fed and the Bank of Canada, Kim?
Well, keep in mind, I'm the bottom-up investor.
Yes.
I'm sitting beside an expert here overall. But, the stability of interest rates and the ability of consumers and businesses to forecast how to operate going forward in the future is important. Yeah. But the big benefit for Canada right now is interestingly enough, inflation's a challenge and it's also an opportunity. And historically, Canada has outperformed other major markets when inflation's north of 4%. So this isn't necessarily bad for investors in the Canadian stock market today.
I mean, you were talking stock market, and then there's the people in the economy, which I think for them, they have a hard time seeing how inflation is generally beneficial. And I hear your point that we shouldn't be making too much of a fuss of this divergence, but it is going to show up in that Canadian dollar. And as I mentioned, that will create a somewhat inflationary effect in this country. It sounds like you're saying it won't be outsized.
Well, what I'm saying is we should be cautious about saying that the only driver of the Canadian dollar is going to be rates, because oil can be a predominant driver. Mm-hmm. And over the past 2 years, the main driver of the Canadian dollar has been neither of those two macro factors. They've been general risk sentiment. So if we persist in an environment where it still continues to be risk off, the stock market is doing poorly, that can lead to Canadian dollar weakness, even if the Fed did raise hikes. So we need to be careful not to try to punish the Canadian economy in order to target the currency. And I think this is what we're going to hear from the Bank of Canada in the next few days. But importantly, I think Kim makes an excellent point, which is that Canadian businesses and households have to know what's going to happen next. A couple of years ago, we got bit from this when we heard from the governor. He said rates are going to stay very low for a long time. I think this did encourage a lot of leveraging. Now we're hearing from the Bank of Canada, we're on pause. Can we take that at face value, or the companies that Kim's looking at have to be careful about another flip-flop down the road? I think that makes a lot of Canadians nervous.
One thing that the Bank of Canada removed from its statement is a reference to excess demand in the economy. Again, kind of a little bit of a victory lap for the Bank of Canada, which obviously that is what you wanted to do with this spate of rate increases, was slow the economy. And it looks like from their perspective that at least excess demand has come out.
Yeah, what is excess demand, though? It's purchasing power and jobs for us. So to me, when I hear central banks say, we want to reduce demand, what I really hear is, well, we want more people to have less money to spend, maybe fewer jobs available in the market. It's a little bit of a code word for that. So this might be a victory for restoring the supply demand in the economy, but it doesn't necessarily feel good to so-called remove the excess demand.
And to put your investor hat on, Kim, this must already be showing up in some of the consumer stocks that you track and look to buy.
Yeah, it's creating opportunity for sure. You've seen major retailers like Canadian Tire have been weak of late, and it's creating this great opportunity to buy a great Canadian icon at really good prices. And it's been pretty volatile. So if you pick your points, I think you can do quite well. Overall, I mean, you can say advantage of that.
You can say that from a valuation perspective, but kind of across the board, you're seeing that slowdown show up in consumer. You saw it show up in the Canadian banks, specifically with respect to residential mortgage lending. And I guess you can rationalize it when it comes to multiples relative to history, but we are talking about an environment of slowing demand and generally restrictive monetary policy. That doesn't really lend itself to a recipe for stock outperformance these days, especially when you're getting a really nice, safe yield in the bond market. How do you justify stepping into these names at these levels?
Well, right now, Canada's trading at a discounted multiple to the rest of the world. We're trading around a 12, 13 PE multiple. The U.S. is up in the 18. Reversion to the mean suggests Canadian multiple will rise over time, and the U.S. multiple will fall back towards that average. And we have this huge gap between valuation between Canada and the U.S., the biggest we've seen in over 40 years. And historically, when you've had this big a gap, Canada tends to outperform. Back in 2000, Canada outperformed the U.S. over 11 years by 9% annualized and 8% for the global market. So it's a very significant opportunity for Canadian investors as it normalized back to a better playing ground and equilibrium between the two markets. And we expect something similar today. So, and yes, consumers may be harmed a little bit in the short term by their income, But Canadians are also very concerned about their future retirement and how it's going to do, and that we have a good economy that will deliver the results so they can retire in their futures.
All right.